At the 2024 Berkshire Hathaway annual meeting, Warren Buffett was asked this question.
And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions. And you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
Warren Buffett just gave one of the most insightful explanations about Berkshire Hathaway's approach to Apple, and it's classic Buffett, humble, rational, and deeply grounded in long-term thinking. Let's break down what he really meant when he addressed why Berkshire sold a chunk of its Apple shares and what it says about how he views business, investing, and even taxes.
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now.
So right from the start, Buffett is making it clear selling Apple doesn't mean losing faith in Apple. He's just doing what great capital allocators do, adjusting positions based on opportunity, valuation, and tax strategy. Even after trimming, Apple still remains Berkshire's #1 holding. That says everything you need to know about how highly Buffett values it.
And so when we own a Dairy Queen or we own whatever it may be, we look at that as a business. And when we own Coca-Cola or American Express or Apple, we look at that as a business.
This line captures the heart of Buffett's philosophy. He's reminding investors that stocks aren't just tickers or charts, they're pieces of real businesses. To Buffett, Apple isn't just a stock symbol. It's a cash-generating company with loyal customers, strong branding, and smart management. That's why he holds it the same way he holds Coca-Cola or American Express, as a business owner, not a trader.
And we have no attempt made to predict markets. We have no attempt made to pick stocks.
That's a striking statement. Buffett is telling investors that the secret to his success isn't about forecasting markets, it's about staying focused on the business itself. He's seen fads come and go, investors chase momentum, and analysts obsess over quarterly movements. But his compass has always been clear: buy great companies and hold them for decades.
But if you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the pronouncements and all of that sort of thing. And
that quote is vintage Buffett, a direct lesson from Benjamin Graham, the father of value investing. He's saying the market is your servant, not your teacher. If prices drop, that's not a lesson, it's an opportunity. Buffett is reinforcing that patience, discipline, and a proper mindset are what truly compound wealth, not constant activity or prediction.
Why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business.
That's Buffett in full confidence mode, calling Apple an even better business than Coca-Cola or American Express. Think about that. This is coming from a man who's held Coke for over 30 years. It shows just how exceptional Apple's economics are. Its ecosystem, pricing power, and brand loyalty make it almost untouchable.
And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place.
Here, Buffett's looking far into the future, beyond his own time at Berkshire. He's saying these businesses are so solid that even under new leadership, they'll remain Berkshire's core holdings. That's not just investment confidence, that's legacy thinking.
it doesn't bother me in the least to write that check. And I would really hope with all that America's done for all of you.
This part took many people by surprise. Buffett actually welcomes paying taxes. He's highlighting that taxes are the cost of doing business in a prosperous system that made Berkshire possible in the first place. And by selling some Apple shares now, he's locking in gains at a 21% corporate tax rate, which he suspects might rise soon. In classic Buffett fashion, he's turning what most people see as a negative, paying taxes, into a sign of success and gratitude.
If I'm doing it at 21% this year and we're doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year.
That final line ties it all together. Buffett's not selling Apple because he's losing faith. He's selling a little now because it's smart to do so under current conditions. He's being practical, not emotional. He's balancing the long-term strength of Apple with the short-term realities of tax policy and capital allocation. So what's the big takeaway? For Buffett, investing isn't about timing or trading. It's about owning businesses you truly understand and thinking decades ahead. Selling a bit of Apple doesn't change that philosophy. It's just another move in a much bigger, long-term game of intelligent capital management. If you found this breakdown helpful, make sure to like the video, subscribe, and turn on notifications because we'll keep unpacking Warren Buffett's timeless lessons in real time just like this one.